Hello and welcome. Thank you for joining us in this webinar. I'm Nicole Aubrey, the Head of Wholesale Distribution at Associate Global Partners. Today, we have the pleasure of speaking to Ryan Quinn, Client Portfolio Manager at WCM Investment Management, to discuss the WCM Quality Global Growth Equity Strategy. Before we begin, some brief housekeeping and a message from our compliance team. Firstly, this is a live and interactive session, so we'd love to hear from you. If you have any questions that you would like us to address, please submit them via the questions box in the control panel on your screen. We'll endeavour to get to these questions towards the end of the session. Please be aware that the session will also be recorded. Secondly, this webinar is for educational purposes and of general nature only. It does not constitute personal advice and it must not be acted on or relied on. The presentation is not an offer, a recommendation or a solicitation. Ryan, thank you for your time today.
Thank you.
For those of us, our audience who are unfamiliar with WCM, can you give them a bit of an overview of the business and how long you guys have been around?
Absolutely. We are a global equity manager based in Laguna Beach, California. We manage portfolios that attack growth equities across the globe and market caps. We tend to enjoy businesses or invest in businesses that are getting stronger over time, that are supported with well-aligned, strong, and adaptable cultures. We think being in Laguna Beach is a competitive advantage for us. Markets can be quite noisy, and we're well removed from the noise of pressures or influence of others inside our industry. And we just get to really exercise our philosophy and process in a way that we think we make very clear-headed and unique differentiated decisions.
In the global equity asset class, the allocation of different investment styles such as value and growth can have a significant impact on the overall portfolio performance. To put this into perspective, growth stocks have outperformed by 27% in 2023. What do you think is the appeal of growth stocks?
For us, it's durable growth. It's being with businesses that are in industries and companies that provide products or services that have really long-term global tailwinds that are the future of company growth. Frequently, businesses will mature to a certain point and they become good businesses, but for the growth sector to be very exciting, there's innovations within healthcare, innovations within technology, even innovations within areas of industrials, businesses that make growth investing particularly exciting, and the potential for very strong growth in the future is probably what attracts most of us to it.
Excellent, thank you. And there are signals that growth still has some more headroom in 2024. Do you think that growth stocks can still continue to outperform this year?
I believe they can. What we saw last year in 2023 was a bit of a narrow market rise, but broadly equities had done well. From a multiple perspective, indices and portfolios seem to look fairly cheap. So that tells you that the growth from last year was really through earnings growth. And earnings growth is the healthiest way for an index or for the market to grow. And so given that our businesses are showing really strong quality earnings and guiding towards continued strength, if not even accelerating strength, maybe in 2025, I do believe that there is room for the rest of the market to grow in the coming quarters and months.
Fantastic, thank you. And if we turn more specifically to the WCM Quality Global Growth Strategy, how has WCM applied this growth style specifically in their portfolio?
Sure. Specifically at WCM, we look for competitive advantage. We want to make sure we can identify businesses that are growing their competitive advantage. It's a take on Warren Buffett's view of an economic moat. We want to be able to identify a moat that is growing and getting wider rather than staying stagnant or at worst shrinking. So from that perspective, it's both a buy and a sell signal. When we can identify a company that is growing its competitive advantage, we can point to the drivers of that competitive advantage and keep track of them over time. At the point with which the competitive advantages are either challenged, weakened, or maybe potentially disappear, that will become a pretty strong sell signal for us. And by managing a high conviction portfolio of just 35 to 40 stocks, it's very easy to switch out a name that might have a moat trajectory that has weakened with something else on the sidelines that we've liked in the second place. In addition to the moat trajectory piece, we focus on corporate culture. WCM has grown and seen fantastic success by focusing on our own culture. We want to make sure we have a very strong, healthy, and well-aligned culture with our business goals. And so we've turned that lens onto the companies where we invest. We find that a company's culture will define employee behavior, and employee behavior ultimately decides whether or not a business grows or shrinks in the face of either headwinds or tailwinds in the economic environment. So the way we tend to skin the cat is that we will look for businesses where we can identify that competitive advantage growing, and then we want to go a bit deeper and take a qualitative look at a corporate culture to help us make that quantitative decision of owning the business for the very long term.
Fantastic, that's very insightful. And so there's been a strong quarterly earnings period in the US, and among the companies that have reported, 5 of the 7 of the Magnificent Seven have exceeded analyst expectations. Can you tell us which of the Magnificent Seven WCM own currently?
Absolutely. In order to get exposure to cloud computing, we purchased Microsoft and Amazon about in 2022. Last year, we were able to get access to NVIDIA and added that to the portfolio. So we're quite comfortable owning those 3 of the so-called Magnificent Seven. We don't necessarily feel pressured to own all of them, or just because they have a catchy nickname. But each individual company plays a really significant role in the portfolio, whether it's exposure to Microsoft Office or cloud computing or Amazon Web Services or their cloud computing business. But the CUDA system within NVIDIA really made it much more attractive and transitioned that business away from a video game processing unit business to really the leader within artificial intelligence.
Fantastic, thank you. So many people are talking about the Magnificent Seven at the moment. Very topical.
Hopefully they stumble over the word magnificent like I do.
Yes, exactly. Well, don't we all? And can you just provide a bit of an update on the strategy's recent outperformance and talk us through the sectors and the holdings that have been the main drivers of this outperformance?
Yeah, performance was quite broad for our portfolio last year, which is in contrast to what we saw in the marketplace. We saw some of our luxury names contribute positively to performance. Within the technology sector, we did see a bit of a resurgence of tech spending, which had been cut back pretty significantly in 2022. So the semiconductor-related businesses we own were strong performers. In addition to our Mag 7 names like Microsoft and NVIDIA and Amazon that we just referenced. So quite pleased that those were strong. From a healthcare perspective, one of our other very large sector overweights, we did have exposure to Novo Nordisk throughout the year. GLP-1s or their diabetes and weight loss drugs were almost as lauded or reported on as AI was. So we were happy to have exposure to one of the leading companies that producing those GLP-1s, which are going to help diabetes and obese people manage those issues.
Thank you. That's very insightful. And there's been a couple of changes in the portfolio recently. Can you talk us through a couple of the new stocks in the portfolio?
Sure. I think one really good example of the way WCM invests is looking at General Electric. We recently purchased that in the global portfolio. The company has gone from what was a fairly messy conglomerate and has gone through a phase of divesting different businesses that were no longer attractive, one being a healthcare business, another energy-related business, to become kind of a pure play on aerospace and jet propulsion. Their CEO, Larry Culp, comes to them from Danaher and is very much focused on the qualities that'll make an aerospace business really succeed. General Electric has about 100% market share within the Boeing narrow-body airplane, about 70+% market share of the Airbus narrow-body airplane, and they sell the engines that make those planes go. What's attractive to us about that business is that the airline industry is requiring planes to fly for longer, which means that once the GE engine is on the plane, then the maintenance contracts will provide a recurring stream of revenue to obviously keep those planes moving safely and in a very efficient manner. So culturally, we're excited about the business being much more focused onto that aerospace vertical. Leadership comes from a proven leader from a great company like Danaher. and also the industry dynamics of requiring engines to be flying on these planes for much longer really lead to an investment we're excited about for the long term.
So Ryan, WCM also run a global small cap strategy that is now available to retail Australian investors, and it has also had a particularly good start to the year. Can you tell us what's been driving the outperformance in the small cap strategy?
Absolutely. Similar to the global large cap, we've seen a strong absolute return from 2023 in our stock price performance, and yet multiples also remain fairly well depressed. So that points to a very healthy earnings growth driven portfolio. The small cap strategy, while certainly lower in the market cap spectrum, plays upon many of the themes that our larger cap portfolio will play on, just with different companies, and in many cases in different countries as well. As an example, Japan is overweight in the small cap strategy compared to the large cap, but it does have exposure to similar themes like outsourced healthcare businesses, some defense businesses, outsourced ICT companies, and even mobile payment systems. So you can think about our small cap strategy as the opportunity to get similar global tailwind themes, just with businesses that have a longer runway of growth in front of them.
And what particularly makes the WCM small cap fund different to other small cap funds that our investors might have seen, do you think?
We leverage that skill or the differentiating factors that we have at WCM in terms of identifying competitive advantages, and also leverages that culture work that we do. We can very much take the same learnings that we got in the large cap space and apply them to the small cap space. And in fact, that's how historically WCM will grow as a business, because we want to understand how to drive performance first. And then the opportunity or the market set with which we will apply those skills to will vary based on where the market is at the time. And so small caps have been a tremendous place for us to invest. They're frequently precursors into businesses that will end up in the large cap strategy. But many times there will be a pattern recognition portion to it, where we'll see similar themes coming from other either larger cap or different economies that we're finding in small cap space.
Excellent. And maybe you could run us through an example of a stock that you're finding quite interesting in that small cap space at the moment.
Sure. So going along the lines of maintaining some similar themes, we're seeing defense spending up on a global basis. That has shown itself in a few different holdings in our global strategy, but as it relates to the small cap strategy, we recently purchased Saab. Many or some people who watching this may remember Saab as a bit of a junky car maker that everybody wanted to buy despite having a horrible service record. But they are no longer a car manufacturer, and they are actually a defense business. So they offer products, I guess they offer vehicles and machines that sell across all three theaters, both land, sea, and air. And so it's really become a turnaround business that has abandoned what was a failing auto business, and it has really grown to become a unique defense contractor.
That's really interesting. I never would have known that's how Saab ended up.
You're not buying planes?
No, not this week. Well, thank you very much for your time, Ryan.
My pleasure.
And thank you for everyone who joined us today. If you've asked a question that we didn't get to, then a member of our team will follow up directly after this session. If you have any questions about the fund, please contact us by calling 1300 052 054 or emailing us at invest@associateglobal.com.